Hello everyone, this is Coach Wade and I'd like to welcome you guys back to my channel. So hope you guys will like, share, and subscribe. In today's video, I would like to speak with you guys about the basics of investing. And the reason I likely go into this topic is because right now we're in times like any other. We're going through a pandemic, aka the coronavirus at this present moment, and there'll be no time in history like probably like we're dealing with right now. And I don't want people thinking back, when we look at this as history and we're kind of like looking back and wishing they shoulda, coulda, woulda. Because right now is probably the best time, if any, to go ahead and get started because people are getting access to money that they never had before. Okay, and I'm not telling you guys to take all the money that you receive through tax refunds, stimulus checks, things of that nature. People coming across tens, thousands of dollars, and I'm not telling you guys to take all that money and put it into the market. What I am saying is it is a good time, to go ahead and start setting up your emergency funds. Also, start to invest. Starting to invest some of the money, not all of it, but at least a portion of it. Go ahead and start investing. Right now is a good time. And with this video, I like to go into some of the basics because a lot of times when we talk about investing, people wonder, how do I get started? What exactly is investing? What's all included? What is a mutual fund? All these different questions come up. And so what I like to do right now is share with you guys, this brief presentation to show you guys what exactly is the basics of investing. Okay, so go ahead and sit back, relax. Hope you guys enjoy. So I'm going to share my screen. Just give me 1 second. Hold on 1 second. Hopefully you guys can see my screen. But most American families live in either a debt cycle or a cash cycle. Okay, so this is what we're going to begin with. So you're looking at a debt cycle. This is when your finances control you. You're outspending your income. You're spending more than what you're bringing in. You're borrowing to maintain a lifestyle. Okay, so and you're paying off one debt and you're accruing another debt. So you're stuck in this vicious cycle. That's a debt cycle. Now, a cash cycle are for those families that are in control of their finances. They're debt free. They're paying with cash instead of borrowing. They have investments, they have savings, and they have assets and accumulating assets. That is the cash cycle. Nobody has to tell you, which cycle you're in. You already know what cycle you're in. You know if you're in a debt cycle, and you know if you're in a cash cycle. But if you are in a debt cycle, you want to eventually move over to the cash cycle. And if you are in the cash cycle currently and presently, you want to maintain in the cash cycle. Now, what is the solutions for this? There's going to be two solutions, okay? Step one is going to be to pay yourself first. You're going to set up three fundamental accounts. I know we discussed this a little earlier about what those three fundamental accounts are. We're going to reiterate that in this video. Step two is you want to eliminate debt. You want to set up a debt stacking program. If you've never heard of debt stacking, hey, listen out. We will be going over that a little later on within this presentation. Step one, as we mentioned, pay yourself first. So those three fundamental accounts are going to be number one, the emergency account. So your goal for the emergency account is have up to 3 months of income saved up. And this is going to be for emergencies. Any purchase you plan on doing in the next 2 years, vacations. This is what you have for your emergency account, okay? Number two is going to be your short-term account. And your goal for your short-term account is to have up to 6 months of income saved up. And this reserve is going to be for unforeseen events, whether it's loss of job, you become disabled at work, so you're dealing with disabilities, short-term purchases. Maybe you want to go look for a car, maybe a down payment for a house, or you're looking to purchase, plan on doing a purchase within the next 3 to 5 years. That's going to be your short-term account. And the third account, which is your wealth building account, aka your long-term, account. You got the short-term account, you got the long-term account, but the names could be used vice versa. So in this case, we're going to be calling it the wealth building account. And within your wealth building account, the goal here is retirement funds. Whether it's in a Roth or traditional IRA, or if you're working and you have 401k, deferred comp, TSAs, tax deferred accounts, whatever it is you're dealing with, is to help you accumulate wealth. Okay. So these are your long-term accounts. Your wealth building account is going to be your long-term account. So if you start from scratch, you don't know exactly where to start. You need to build all three of your funds because you don't have any. How do you fund it? How do you get started? You want to go ahead and you want to start investing right now. So let's say, give an example here that you have $200 that you can contribute on a monthly basis. So what you're going to do is you're going to break up okay, that money and fund all three of your accounts. So you're gonna put 50% of that $200 inside of your emergency fund. So you can put $100 inside this emergency fund because 50% of $200 is $100, right? So you'll put that right there. Now the other 25, the other 50%, you're gonna break that up. You're gonna put 25% into your short-term account, and you can put 25% inside of your wealth building account. All right, so that's gonna be $50 in your short term, $50 in your wealth building, and $100 in your emergency fund. So once you have your emergency fund fully funded, and that's gonna be with that 3 months worth of income saved up, then you're gonna take that $100, you go put that inside the short term account. So now you're putting $150 inside your short term account. And once you fully fund that, like when you have your 6 months, worth of income built up in there, then you'll take that $150 that you're paying right here and apply it to the wealth building account. Now you're applying all $200 towards this wealth building account. And this just give you an example of how to start funding this account. Of course, when you start getting things like stimulus money, when you start getting tax returns, that can help you speed up the process in funding, these accounts. So you start focusing in on building wealth and building on your assets. Now, the types of accounts you want to break this up in is for your emergency fund, you want 100% of your emergency fund inside of a money market fund. And I'm not talking about one of those FDIC insured money market funds accounts that you get, or money market accounts, should I say, that you'll get, when you open up a checking account. Not that type. The type of money market fund we're talking about is one where it takes somebody that has a securities license to be able to open that up for you. Okay? Your bank probably has it. They have financial advisors. They have things like that. There's a lot of people you have access to in order to go ahead and start that money market fund. Okay? Or if you're doing an E-Trade account or whatever, you have money market funds you can have access to. All right. So you also have short-term funds. And your short-term funds, you want this to be inside of a conservative allocation. Okay. You want that to be conservative, and you want to be able to have access to it if need be, to be able to easily convert that into cash. Now, with your wealth building concepts for your wealth building account, these are your retirement type of accounts. And you see the arrow here. You have your growth years, which is going to be early on in life. This is your cash accumulations side of it. Then you have your retirement age, which is the target, your retirement age. And after that are your income years. Okay, so this is later on in life. Once you retire, now you're no longer looking for growth. Now you're looking for income. So in your growth years, you're gonna fund this part of your life with growth funds. Okay, growth funds. So what a growth fund is, it primarily invests in common stock or well-established companies. Okay, so this type of fund may invest for long-term capital gains, and it's not intended for investors who are only seeking income. Okay, it's for folks that are seeking growth. So those are growth funds. You're gonna have that during your growth years. Once you hit that target, once you hit retirement age, now your income years, now you're looking at income funds and balance funds. So your income funds are going to invest in either corporate, government, or municipal debt securities, which we call bonds. Okay. So in a debt security is an obligation which pays interest on a regular basis. So that's how it's going to generate its income, because it's paying interest on a regular basis. Now your balance funds is going to be a mix between growth funds and income funds. So it's going to be achieving both. It's going to be looking at growth and it's going to be looking at income. So it's like a good little mix. But that's kind of like what you're looking for your retirement age, your retirement years. And now you're looking at income funds and balance funds. Okay, so this give you an idea of the wealth building concepts. But keep in mind, this information I'm sharing with you guys right now is not a recommendation for you to buy or sell securities. I'm just sharing this information with you for informational and educational purposes only. I'm not acting as your financial advisor. Okay, so sit down with your financial advisor. Only thing I'm sharing with you guys today is just the basics of investing. Okay. And one of the most effective long-term investment vehicles are mutual funds. Okay, so mutual funds are basically individual investors pooling their money together and having it professionally managed. Okay, and it's inside of what we call mutual funds, which is like a fund of funds. So it's like a fund that has a whole bunch of different companies in there. So you put in a little bit of money, y'all sharing that together, putting a little bit of money, but it's spread amongst all these different companies. And it's in a variety of different types of funds, such as consumer funds, which consist of many of the companies you know and trust. This is just an example. You have companies like Procter and Gamble, okay, company. You have Folgers, Crest, Duracell, Gillette, Tide. We know about these. These are consumer goods. You have entertainment stuff like the Walt Disney Company, ABC Television. All this, the Walt Disney theme park. This entertainment funds. You have pharmaceuticals wrapped up in there. Pfizer, okay, Zyrtec, Celebrex, all of these. Telecommunications such as Verizon Communication Wireless, AT&T, Sprint, consumers such as McDonald's Corporation. You have technologies such as Microsoft Corporation, Xbox video games. They have Windows, all that stuff is what Microsoft has, right? So the only way that you can lose all your money when you're dealing with a mutual fund is if every single company within that fund loses money. So, which is not likely. It can happen, but it's not likely, right? So again, a mutual fund is going to be a pool. It's going to be individuals pooling their money together and having that money professionally managed. Okay. But whenever you're dealing with investing, it's good to keep your focus on your goals and remember the 3 Ds of investing. There are 3 Ds of investing. Clear my throat. So you might hear me cough a little bit, but my throat's drying out on me. But 3 Ds of investing, that's going to be dollar cost averaging, discipline, and diversification. Okay, I'm going to repeat that. Dollar cost averaging, discipline, and diversification. Now, dollar cost averaging, I know you guys heard me say this in other videos, dollar cost averaging. So basically, dollar cost averaging means investing a certain fixed amount of cash, each month, regardless of what's happening in the stock market. You're investing the same amount of money every single month, automatically coming out, right? And this eliminates having to predict when to invest, as you'll be able to take advantage of the market highs and lows, okay, by purchasing fewer units when the prices are high and more when the prices are low, all right? But while dollar cost averaging can't assure a profit or protect against loss, it does show how a systematic investment plan sustained over a period of time has potential to pay off. Okay, relieving your worries about whether the market is up or down because you're taking advantage of either situation where the market is up or where the market is down. All right. The next one is discipline. You're disciplined by staying focused and staying invested through all market activity. Okay, so you can increase your long-term potential because missing even a handful of best performing days in the market over time can considerably diminish your returns. So experts say market timing is a bad way to invest. You don't want to do market timing, right? The key is to maintain a long-term view and stay focused on your goals. Hence, remain disciplined. Whether the markets are up or going down, remain disciplined and continue to invest, irregardless of what the markets are doing. All right, so next one is diversification. Diversification. Because there's no single perfect investment. You want to take advantage of the next best thing, which is to build your portfolio by balancing a variety of investments. Together, these investments help you achieve your goals and reduce your potential risk. Okay, it doesn't eliminate your risk, but does reduce your portfolio's risk. This may also work to increase returns by offsetting losses in one asset class with opportunity of gains in another. So diversification does not assure profit or protect against loss. So keep that in mind. But it's good to have a good little mix there. So if one's doing bad, another one's doing good, they kind of balance each other off, okay? You don't have all your eggs in one basket. And a good way to do that is through mutual funds, all right? It's like the fund of funds because it's already diversified. You don't have to worry about doing any market timing or anything like that. You let the professional money managers deal with that, okay? So we're dealing with systematic investing. We mentioned dollar cost averaging. How does that work? So right here we have an example, right? We have an example of two investors. They're both contributing $100 per month. Okay, they're both contributing $100 per month. All right, so you have investor A, and with the stock, he's still investing $100, but the price of the stock continually increases, right? Continually increases. And then you have investor B, who invests inside of a fluctuating market. He's investing $100 a month as well, but you see his starts right here, goes down, and comes back up. So looking at this graph, who do you think has the most money? Investor A or investor B? Many people just looking at the chart will automatically probably say investor A because his money is steadily going up, 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 up. But the actual answer is investor B. The one that's dealing with the down market and it comes back up. That's the one that's actually made the most money. So look at a breakdown of that, okay? You have investor A. Investor A contributes $100 a month. In month one, the stock price is $10. So he buys this stock at $10, per share. All right, so he gets 10 shares. Because 10 times 10 is $100, right? So he gets 10 shares. Month two, the price went up to $12. And so this go around, he buys 8.33 shares. All right, still the same $100. Month three, he puts in $100. It's at $14 a share, so he buys 7.14 shares. So he does that all the way through month six. Month six, he's back at $20 per share, and he buys 5 shares. So number of shares accumulated is 42. Now investor B, here's the one that went down and came back up. So in month one, $10 a share, he bought 10 shares. Month two, it dropped to $7. He bought 14.29 shares. All right, month three, it went down to $4. So he's able to buy 25 shares. Month four, it was $2 a share. So he was able to buy 50 shares. All right, so you see, the lower it went, the more shares he was able to buy. Then it went up to $6, right? It went up to $6 a share. He was able to buy 16 shares. And then it went right back where he started at $10 a share, but he's only able to get 10 shares. If you look at the end of the day, he had 126 shares versus 42 shares. So the person that dealt with the dip in the market and going back up actually fared better than the person who dealt with the one that steadily increased. Why? Because the one that steadily increased, they bought fewer shares. The one that had the fluctuation, it dipped, they already bought more shares. And when it came back up, the price of all those shares they bought low have now appreciated. So I hope you guys can see that visual now. All right, so you can see the visual of what exactly dollar cost averaging is. All right, so amount invested in 6 months, investor A, investor B, they both contributed $600. The shares, investor A had 42.28 shares, whereas investor B had 125.95 shares. And the average cost per share for investor A was $14.19. But the average cost per share for the person with the investor B was $4.76. So what that tells us is a person that deals with the fluctuating markets, even though they're dipping and increasing over a period of time, they're paying less for their shares and they're getting more shares. All right. So that's the whole concept of dollar cost averaging. All right, so the next step, the step number 2 is to eliminate debt. And this is when you get the debt stacking. All right, debt stacking. And some people do debt stacking by lowest balance, focusing on lowest balance to highest balance, or some people look at highest interest rate to lowest interest rate. But however you're doing it, just stick to the system, remain disciplined when you're dealing with debt stacking. But there's an example here. You have an individual that has retail card number 1, right? He's paying $220 a month, for the retail card. He has credit card number 2, where he's paying $353 a month. He has a car loan for $551 a month. He has credit card number 1 for $303 a month, and he has a mortgage, which is $1,293 a month. So for the total month, his total outlay is $2,720. All right. So what happens now? So now he's paid off credit card number 1. He just freed up $220 because he just eliminated that debt. What does he do with that $220? Does he take it and just blow it? No, he takes that money, applies it towards credit card number 2. So instead of paying $353 on the card, now he's paying $573, and he's paying the same thing on everything else. Okay, so his total monthly outlay is still $2,720. So now he's paid off credit card number 2. He just freed up $573. Now he's going to take that $573 and apply it towards the car loan. Now he's paying $1,124 towards the car loan because that 573, $573 plus that 551 is going to total $1,124. Now he's paying all that towards the car. He's paying the same towards everything else. Still, monthly outlay is $2,720. Excuse me. So now he's paid off the car. He's freed up $1,124. So what he's going to do with that, he's going to take that and apply it towards credit card number 1. All right, so now he's paying a total of $427 towards credit card number one. And with the mortgage, he's paying still the $1,293. So total outlay is still $2,720. Now that he's freed up the credit card, he's freed up $1,427. Now he's applying the whole $2,720 towards the mortgage. All right, and he eliminates that debt. So without debt stacking, it would have taken this individual 24 years and 3 months to pay off all this debt. All right. So interest paid over the life of that loan, they would have paid $214,432 in interest. Monthly payments, again, $2,720. So now you look at that picture with debt stacking. By freeing up that money and applying towards the next debt, you see the difference. Just by doing this debt stacking, not paying anything different out of pocket, they're able to pay this loan off in 9 years and 1 month, 182 months sooner than the person that just did it without debt stacking. Total amount of interest they're saving is $130,643, which they can put back into their pockets. They can put that interest back into their pockets. That can go to their retirement account where that money is working for them. They can build an asset with that $130,000 just within that 9-year period of time. All right. Well, they won't have 130,000, but 130,000 is pretty much if they kept on, that's how much they save, instead of paying 24 years. But they take that and they can take that money after they paid everything off and start investing that. The whole 2,720 can now go inside of their investment account. By the end of 24 years, they could have easily multiplied this money, 100 times. I don't know how many times over, but they can truly multiply this money. But anyways, interest paid, they only pay $83,789 interest. And again, it's the same monthly payments of $2,720. The same monthly payments, $2,720. All right. So that's the power of debt stacking. And this right here is the basic of investing. Eliminate your debt. And once you eliminate your debt, you can take that same money and start investing it. Start building assets. Grow that money. Allow that money to work for you instead of you working so hard for the money, right? So keep that in mind. So these are the basics of investing. I'm going to go ahead and stop this and go back to my main screen. So hold on for 1 second for me. All right, looks like we're back up. So I just wanted to thank you guys again for watching this presentation, and hopefully you're able to get a little groundwork when it comes to the basics of investing. As I mentioned earlier in the video, there's no time, in history like it is right now, where people are getting tens of thousands of dollars into their hands, whether it's from their tax refunds, in addition to what they're getting with the stimulus package. So what are you going to do, with all of this money? Are you going to just be a consumer, or are you going to use this to help you propel yourself forward for the future? All right. So the only thing I can do is share information with you guys. So hopefully you do something with it. I'm not acting as your financial advisor. I'm not telling you guys what to invest in or anything like that. You might want to speak with a proper professional in terms of knowing, what to invest in. So be able to seek out your financial advisors to figure out what that looks like for you and your personal situation. Everybody is different, so everybody has a different, outlook in terms of what they want to invest in, what they want to save in, because everybody has different situations. Some people are married, some people are single, some people make this much, some people make that much. There's a whole bunch of things that come into play. Some people are willing to take more risk than others. As we mentioned in earlier videos, sometimes the higher the risk, higher the reward. But again, you don't want to be silly with your risk, okay? You want to take calculated risk. So be sure to check out this information. Feel free to watch this video again. Hopefully, again, that you guys were able to get something from this. And investing is something that people have been doing for years. Make sure you guys do some research, read, take a look at some finance books, some investing books. One book that I like, I wish I had it right here in my hand. It's actually on my bookshelf, but it's called "It's Money, Master the Game." It's actually written by Tony Robbins. I encourage you guys to read that book. It's 300 some pages, but if you're not like an avid reader, don't like doing a lot of reading, read 10 pages a day. 10 pages a day. You have the book read in a little over a month. Just reading 10 pages a day, and you go through that 300 page book like it was nothing, right? 10 pages a day, but it's jam packed with information. That's Tony Robbins' Money Master the Game. I mean, that changed my whole perspective on a lot of things. I've always been investing. I've been investing since I was 19 years old. I'm 39 right now, so that's been about 20 years. But the whole key point of the whole key factor is it changed my mindset. It changed the way I view things. He pretty much interviewed a lot of wealthy money managers that are out there. A lot of people and some of the people you might not know them specifically, but you know the companies that they work for or some of the work that they've done. But he's interviewed them and they gave some powerful points and tips, things that they're investing in, and it gives you a good idea in pretty much in how you should be doing your stuff. So folks, I really encourage you to read that Tony Robbins Money Master the Game. I'll try to find an Amazon link or something like that to take you directly to that book so you can check it out for yourself. But it's Money Master the Game, and I will put that link again in the description field of this video. But again, I hope you guys enjoyed. And feel free to share this information with your friends. As today we talked about the basics of investing. And of course, it's not everything, but it's a good place to start. Okay. We talked about, setting up those three fundamental accounts. And we talked about also, getting out of debt. Getting out of debt is crucial because that's the thing that's holding a lot of people back is getting them stuck inside that debt cycle, because they constantly have to borrow money to make ends meet. Seem like there's no light at the end of the tunnel, but folks, there is light at the end of the tunnel. You are not alone. You're not the only one that's living paycheck to paycheck. A lot of people are living paycheck to paycheck. A lot of people are one paycheck away from devastation. Okay? They can't go a couple months, without an income. They don't have anything saved up because money comes in, fast as money comes in, as fast as money goes out. But you can always change your situation. All right? Because education changes situations. Education changes situations. Become an avid reader. Readers are leaders. All right? And leaders are readers. So be sure to read to change your mindset about money. Okay? Because again, money's not everything. I would never say money is everything because it's not. Because you become a millionaire and still be depressed. It's not about money. It's about contentment. But at the same time, why make your situation worse, by adding compounding on there, financial stress. Financial stress should be the least of your worries. Be content, but also at the same time, do better. Learn, grow. Because we're not learning, we're dying. So I encourage all of you guys to continue to stay focused, dig down deep, pick up some books, read it. Be sure to check out Tony Robbins' book, Money Master the Game. And again, I will put that link in the description field of the video. And to meet again, you guys have yourselves a great day.